Well, good morning, everyone, and welcome to the Experian Quarterly Business Credit Review for Q3 2017. I'm Gary Stockton, and before I introduce our speakers, I'd just like to remind you to take the opportunity to engage our experts today using the question and answer box that you should see on the WebEx toolbar. We're going to try to answer as many questions as possible throughout today's program. Please visit help.webex.com if you are having any technical issues. Hopefully you are not. If you are, maybe reboot the WebEx applet if you're having any trouble at all. But also keep in mind that we will have a recording of this session up on the website in a matter of hours afterwards. During today's program, we're going to be discussing key findings in the most recent Experian Moody's Analytics Main Street report for Q3 2017. We'll be sharing a link to the download for the slides from today's presentation at the conclusion of our talk. We'll also be circulating an email afterwards with a link to that. Our speaker today will be Gavin Harding from Experian, Derek G. McCrank from Moody's Analytics, and Kyle Hellman also from Moody's. With more than 20 years' experience in banking and finance, Gavin Harding brings a deep understanding of both the issues facing clients and practical challenges involved in implementing solutions. Mr. Harding has worked closely with many of Experian's online marketplace lending clients and financial services clients, helping them manage risk, improve efficiency, and achieve sustainable growth. Derek McCrank is an associate economist at Moody's Analytics and a member of the Credit Analytics Group in Westchester, Pennsylvania. Derek works on building stress testing models of consumer loan performance for a number of consulting projects. He has a bachelor's degree in economics from the University of Wisconsin-Whitewater. And Kyle Hellman is an economist with Moody's. He's a member of the Westchester, Pennsylvania Credit Analytics Group. Kyle builds and maintains consumer credit models and researches and presents trends in consumer credit markets, as well as the broader economy. Kyle holds a master's degree in economics from Temple University. And now I'd like to introduce Kyle Hellman from Moody's to kick off today's program.
Sure. Thank you very much, Gary. So good afternoon or good morning for those of us on the West Coast. As Gary mentioned, just like to touch on the broader economy and how it impacts both credit and small business trends. So in general, the economy is on sound footing. We're about 8.5 years into the current economic expansion, and this would make it the third longest expansion since 1945. And the key driver of growth has been employment gains. So since the recession, firms have added roughly 200,000 net new jobs each month on a remarkably consistent basis. Employment growth hasn't been very rapid, but it's been very robust. So it's weathered external shocks to the economy that maybe in a different cycle might have knocked hiring down. For example, it weathered the European debt crisis in 2009, 10, and 11, but also the rapid decline in oil prices in 2015, 16. So it proved to be incredibly robust to shocks to the economy. Moreover, what we're seeing now in the most recent year, most recent quarters, is that hiring is beginning to broaden, right? So the distribution is becoming more even. Earlier in the cycle, hiring was really confined to certain industries. Technology and finance are good examples, or certain regions of the country, coastal areas and urban hubs. Now we're beginning to see a much broader distribution of employment growth across industries, across regions of the countries, and across firms of different sizes. As a result, the unemployment rate has fallen to 4.1%, and labor market tightness has really shifted negotiating power from firms to employees. And it's put businesses in a position where they have to raise wages to either entice new workers or even to just retain their current labor force. In some industries, this has led to some labor shortfalls, which is a point that's actually echoed in some of the surveys of small business owners. So the general health of the economy has also been a boon to consumer credit markets. Consumer credit markets, as I'm sure you're well, are a key indicator for credit trends within the small business space. So total balances depicted here as the bar chart, or the bar portion of the graph, are growing at roughly 4.2% year on year. So this is on par with the fastest pace since the expansion started. And it's really been driven by a number of different segments. Mortgage lending is doing very well. That accounts for about 2/3 of the total market, growing at about 4.1%, just over 4%. However, a number of above-average growth industries or segments. The bank card market is growing at about 7.3% year-on-year. Balances within the auto sector, so across loans and leases, bank and finance loans, it's about 5% year-on-year growth. And then in the consumer finance space, the personal loans, again, we're seeing about 5% year-on-year growth. These are very strong rates of growth, very robust. The credit cycle is reaching a key part of its expansion. However, performance within this space has also remained relatively outstanding, right? So total delinquencies account for less than 3% of all outstanding balances. So that's extremely low on a historical basis. And then total losses on an annualized basis are only about 1% of outstanding balances across all products. So performance has remained relatively robust, even though growth is beginning to accelerate and reach some total balances are reaching new highs. So while the economy on balance is in good position, there are some risks that we're paying attention to. The most salient one, or the one that we think we'll experience first, is an increase in interest rates. So we're expecting a 25 basis point increase in the Fed's fund rate this month, likely announced on Wednesday or tomorrow, and then roughly 1 hike per quarter through decade's end. So our forecast is a little more aggressive than both that of the Federal Reserve and the broader markets, but we expect the Fed to move slightly ahead of its announcements. In terms of the broader economy, what will the normalization of interest rates mean? There's a couple of different segments that will be impacted. So higher borrowing costs are going to increase debt servicing payments for installment loans, particularly, but also revolving loans if you don't pay down the entire balance on time. This higher debt servicing payment is going to reduce on the consumer side, consumer spending and consumption, but then on the business side will also eat into profit margin. Within the largest sector of the credit market, as I mentioned, it's mortgage. It accounts for about 2 out of every $3 in outstanding balances. Higher mortgage rates is going to have a cooling effect on demand. It's going to slow originations growth, and it's going to have an impact on businesses not only directly within the mortgage space, but any housing-related business will likely feel a slowdown in business as mortgage rates tick higher. The second development we're watching is tax reform. As I'm sure you're aware, it's been in the news. It's a bit of a wild card, so both bills are currently in committee with the plan as stated for a vote on and around December 18th, maybe a day or two later. Since the two bills, the Senate and the House version, where there's some differences on certain provisions, the exact parameters of the final law are unknown at this point. However, we think in general, this tax reform is going to benefit businesses. The corporate tax, as you know, is lowered, as well as the pass-through rate. However, that being said, we think the overall impact on the broader economy in the coming decade is going to be a little more marginal. This tax reform, or the current tax reform package, amounts to about a fiscal stimulus of roughly $1.5 trillion over a 10-year window. To give you some context, the fiscal stimulus package enacted in 2009 coming out of the recession was worth nearly $800 billion. So it's roughly twice the most recent fiscal stimulus package. However, the economy now is much closer to its upper limits of growth than we were in 2009. As I mentioned, the unemployment rate is about 4% now versus 7.6% in 2009. And GDP growth, it hit 3.3% annualized in the third quarter of this year. It was actually negative in late 2008. So the economy is much stronger now, so much sounder footing. We don't believe there's as much room for rapid growth in the coming quarters. So as a result, our long-term trajectory is basically unchanged regardless of which tax reform policies are passed. However, as I mentioned, we do think there will be a short-term impact, a positive benefit in terms of growth. You can see that on the left side of the chart in 2018 and 19. And we think these benefits will accrue mainly to the business side of the ledger. How do we expect these trends to affect small businesses? Optimism in general is very high. Concerns regarding sales have diminished as the economy has grown over the last several years. You can see that in the green line here. Poor sales is becoming less and less of a concern for the majority of businesses. Also, concerns over uncertainty have diminished over the last year. They spiked just into the fourth quarter of last year, kind of just before the election, and they've since come down. So near-term uncertainty has diminished as a concern for a number of businesses. And along with that, optimism for the economy's near-term performance has actually increased. And we expect that this is due in some part to expectations over lower tax rates for corporations and businesses. However, there are some concerns. As I mentioned at the top of the deck, talking about the unemployment rate, firms are having some difficulties finding qualified workers. This trend is consistent with a tightening labor market. The unemployment rate is at 4.1%. Labor shortages at that unemployment rate or that level of unemployment are going to begin to pop up. They've been isolated to a number of industries. Housing is a good example. However, it also speaks to a structural unemployment story, where individuals who were either laid off or fired at the peak of the recession have had difficulty finding jobs in the recent years, and their skills may have atrophied over that time period. So they're having they're having a difficult time finding individuals with the right mix of skills to fill their open positions. And there's also concerns over business taxes. So this is the blue line in the chart here. This is always amongst the most pressing issues for small businesses. As I mentioned, we think that current reform will help businesses, but it's not clear that the impact will be dramatic. And that there are other pressing concerns, labor shortages, that could be addressed through, say, job training that might have a more salient impact on small businesses in the coming quarter.
All right.
Okay. Thank you.
Sorry, Gary, I think I interrupted you.
No, it's okay. I wanted to thank Kyle for those comments, and I just transferred presenter control to you, Derek, so if you want to take it from here.
All right. Well, I'll start out by saying as well, thank you, Kyle. What's happening in the macro economy right now, I think, is going to be one of the top things on the minds of most, if not all, small business owners heading into, or as we're in the fourth quarter and heading into 2018. Getting right into what happened with small business in the third quarter, talking first about the utilization rate. So how much of the available credit small businesses have that they're taking advantage of. And in the third quarter, we saw for the first time in a year and a half that small businesses didn't want to continue utilizing more of the available credit that they have. And it looks likely that this was just sort of a temporary pullback. In the third quarter, there were two really big factors that were affecting small businesses. The first was in the Southeast. We had three severe hurricanes which disrupted business activity throughout the region. And as small businesses had to close to accommodate safety concerns surrounding those hurricanes, it may have impacted their desire to take out new credit during that time, might have impacted their performance, their ability to pay on their existing credit. So that was the first big factor, and we saw that it did impact utilization. And the second factor was at the end of the quarter, as small businesses throughout the country were watching what was happening on the news, they saw that Congress, after moving on from attempting to repeal some of the health care laws that had been enacted, was going to move on to tax reform. And since small business owners are obviously worried about, as we saw in Kyle's last chart, that tax concerns are front and center on the mind of small business owners, if there's a chance that Congress is going to reform the tax code, they may have wanted to hold off on any investment decisions, hiring decisions, anything that would require them to draw on their credit until they had more certainty surrounding that decision. Looking at the performance of small business credit, we saw that it continued to perform well in the third quarter, as has been the trend throughout the history of our data. And this was really a twofold story in the third quarter. So there are two things that are going to impact our performance metric. One is balance growth, because as you see in the subtitle here, our delinquencies are measured as a % of outstanding balances. So as balances are increasing, that can push down delinquency rates and improve and make it look like performance is improving. And then bankruptcy rates, which as those rise, the 91 plus category is going to see improved performance as those bankrupt loans are being pushed off the books and into either bankrupt or charged off and written off state. So improving performance here is really a twofold story. And as we look first at balance growth, we can see that for a number of industries, the third quarter was one of strong growth. In particular, I think it's important to point out mining and transportation and utilities. So in the last couple of quarters, for those of you who have been listening in or reading the report, you'll know that mining and transportation and utility companies, small firms, for the last few quarters haven't been performing as well. They haven't been growing as robustly as other areas of the economy. Say, if you look at construction or financial services or other services, you'll see that there's been strong, consistent growth for the last couple of years. But mining and transportation utility in the third quarter came in quite strongly. So that was one of the reversing trends that really pushed balance growth up over that time. Then turning to the other side of the story, the bankruptcy rate, we saw that in the third quarter it did tick up slightly. So the national average is now about a 15 basis point bankruptcy rate, which is still very low, especially when you look at the earlier in the history of our data compared to a 20 basis point. It's down almost 25% over that time. But it looks like lenders are starting to write off and charge off some more of their bad small business loans and clear those off of their books. So as that happens, we do see improving performance throughout the small business sector. Taking more of a regional view, Wyoming was one of the states which had a rough quarter, and this was for several reasons. So on the last slide, when I was talking about industries, you remember I said mining and transportation were two of the states in the two of the industries, excuse me, which in the third quarter had strong growth and saw improving performance. Well, in Wyoming, this was not the case. So in Wyoming, each of those industries, combined with construction and retail, saw their severe delinquency rate, their 90 days past due rate, increase by over 0.5% or 50 basis points. So we saw that those four industries really had a negative impact on the state's small business credit performance. As a sort of a counterpoint for why Wyoming is still doing okay, their bankruptcy rate compared to the nation is still quite low. So Wyoming currently has a bankruptcy rate of around 11 basis points, which is almost 30% lower than the nation as a whole, which has the 15 basis point rate, as I mentioned previously. But this may be something to watch out for. So as we're seeing these 90-day delinquency rates rise across those four industries, we may see in the future that bankruptcies are going to rise as a result, as more of those 90 days past due loans get pushed into the 91 plus category and just start to pile up a little. So Wyoming is an area to keep on your radar in the next few quarters to see if the bankruptcy rates rise as a result of these increasing severe delinquencies. So at the end of each webinar, we have a Q&A portion, and after the Q2 webinar, one of the questions that we got that we didn't have time to get to during the webinar was how is the retail industry doing in the states of Florida and Hawaii? And one of the ways I wanted to look at this was as comparing all the states and their share of retail industry output as a percent of GDP. So there are two axes here, but there are three things happening in this chart. You'll see on the x-axis, there's the severe delinquency rate, which is the 90 days past due. And zeroing in on Hawaii and Florida, you'll see that Hawaii actually has the third highest severe delinquency rate for its retail industry of any of the states. Tennessee is very close to Hawaii, but Hawaii is actually just edging it out very slightly. And then Florida is kind of mixed in with the pack of most of the states, which is at about 50 basis points for its severe delinquency rate in the retail industry. The second thing that's happening here is the retail trade ratio, which is retail trade as a percent of GDP. And it's important not to confuse this with the third thing happening in this chart, which is a little difficult to tell, but each of these circles is actually a bubble. So the bubble changes in size based on the state's retail sales as a ratio of GDP. So you can kind of see down in the lower side of the chart, Massachusetts and Arkansas have slightly smaller circles when you compare to a state like Arizona or Hawaii and Tennessee. So the size of the chart also matters. And the reason it's important to differentiate between retail sales and retail trade is that one is a measure of value added. So retail trade looks at the value that state is adding to the retail industry. So sales is just the nominal price that you see on the tag for an item you buy. Retail trade is the profit, more or less, going to the small business retailer. So you'll see that there's a bit of a downward trend to this chart. So as retail trade ratio falls, you expect a slightly higher severe delinquency rate in the retail industry in that state. And part of this may be in states that are less reliant on retail for their GDP, their output, employers are a little more willing to sacrifice performance if it means that they can stay current on some of their other bills and put aside payments on maybe one or two balances, but those then result in severe delinquencies occasionally. As far as the outlook for these two states go and their retail performance, so looking at retail trade, you'll see the dashed lines are the Moody's forecasts for those for retail trade in these two states, Hawaii and Florida. We have historical data up through the first quarter, but it's a little tough to keep current with state level data. There's a bit of a lag. So from Q1, you'll notice that our forecast shows Florida sort of leveling off throughout the remainder of 2017, but then picking up sharply and growing back to the level where it's sort of on par with Hawaii as far as its growth rate, not its total retail trade. And on the left axis is Florida's retail trade in billions of dollars, and on the right axis is Hawaii's. So you'll see the levels are very different, but the trajectory gets back to the same going into 2018. The reason I bring this up, though, is so Florida retailers are going to be working with less retail trade growth in 2017, but next year retail trade growth, which is that underlying profit for small retailers, we're forecasting that it's going to rise, which is going to be a boon for small retailers in Florida. So we're expecting that if we go back here, performance, which is already pretty positive in Florida, might be moving even higher to the left in this chart, which indicates lower severe delinquency and a slightly higher ratio of retail trade to GDP. Going back to our forecast, you'll see Hawaii we're projecting that they're going to have an upward trajectory for retail trade growth throughout 2017 going into 2018. So we are looking for their retail performance to improve a little bit over the next few quarters. But getting back to what Kyle was saying, taxes are a huge concern right now, and small businesses are going to be watching closely what is happening in that area, especially going into 2018. So in Q4, investment and performance are going to be a bit up in the air as small businesses hold off and wait to see what's going to happen. But on that note, I will turn things over to Gavin, and he will take us to a new level of granularity within the small business data.
Thanks, Derek, and thank you, everybody, for joining. So we are right now in a situation where there is consistent growth. There's 7.3% growth in bank cards. Personal loans are up 5%. Delinquency is low. Bankruptcy is low. Optimism is high, and there's a little uncertainty about the tax code, the tax environment. So the question we want to ask is, anywhere in that whole picture, is there an indication of trouble? The news is great, but when is it going to turn? Are there any subsections, sectors, industries, regions, or products where we see any noise, any kind of lead indicators of a change or a turn? So the challenge with that is to step away from the macro, to step away from kind of opinion polls and surveys in terms of sentiment, and to really dig a little more deeply into some kind of detailed data, detailed information. So that's what we did. Slight lag on the slide changes, but stay with us. So we took a block of data that we look at every quarter. This data is related to small business. It is, the data set right now is between 45 and 50 million accounts. It crosses everything from utility information all the way over to bank card. It goes down to a very deep level of granularity and detail beyond what you would normally see in a business credit report. So it goes down to the individual transaction level and product level and so on. So it's a really good database to dig into to understand where any of these potential warning signs are, or any potential kind of dark clouds on the horizon. So let's look into it. So when we look at the U.S. in total, we generally divide it for the purposes of analysis into 5 regions. You can see the regions here. I want to pause for a second and just let you guys know that a lot of this data is available on our website on an interactive business credit map, where you can go to your region, to your state, and look at a lot of these performance points for your context. So to help you with that, when we're done, Gary has kindly agreed to send an email out to the group with a link to that data. So I think that could be very helpful. I would advise you and recommend that when you get that link, you go in and dig into it, and you will find more insights and more data that is relevant for your particular context or organization. All right, as we look for these warning signs, we thought about the 3 main products that small businesses access for credit. So we think about credit cards, we think about installment loans, and we think about lines of credit. Each of these sources of financing has some pretty distinct characteristics. So for instance, in the installment loan segment, a lot of the time those loans will be secured. When loans are secured, you can maybe lower your credit standard, widen the box, give more credit to more varied kinds of businesses at different risk levels. On the other side, we've got the credit card product. And as we all know, in the small business world, when businesses start and as they get going, there is a heavy reliance on credit cards. There is a significant crossover between personal credit cards and the owner's credit and small business credit, so there's a significant crossover there. Business credit cards can be rapidly, they're unsecured generally. They can be closed off pretty quickly. They can be, the balances can be reduced and so on. So there's a lot more control and variability on the provider issuer side than there is in the installment loan. It tends to be on the installment side. Once you're in it, you're in it. So we thought it would be helpful to go through each of these product types and understand on a regional level what the variations are. So if you look at this slide on the bottom right, there are 4 metrics. The first is the average IPv2 score. So think about the IPv2 score as like the consumer credit score for business. The higher the score, the lower the risk. The scale is 1 to 100. So let's take a look at that. When we look at the regions here under commercial credit cards, we've got the West at 70, we've got the Southeast at 67, but overall we've got pretty good alignment and clustering around that 68, 69 score. That is a really good credit score above the national average on the commercial side, which tells us that generally the quality standards of origination in the commercial credit card segment are pretty good. Next level down, let's look at those dollar signs. So what this is the average balances on the cards. Again, tight alignment, tight clustering across the country, right around the high 3,000, very low 4,000 level. Balances are not high on average, and again, good alignment. Next percentage down is the charge-off balances. So when you look at that, again, not significant variations, but just as a percentage, a 0.40, a 40 basis point charge-off rate, historically, is really good. That's a good, solid performance, and that aligns with the presentation earlier from Derek and from Kyle. Next level down, we're looking at days past due, 91 days plus. You know, the highest is Southeast at 1.04. Again, very low and very good performance. So overall, in the commercial card portfolio, when we look at it in terms of regions, looks pretty solid and stable. Let's think about installment loans. First thing you see here is that business credit score, the IPv2, the numbers are a little lower. The reason those scores are lower, again, is because credit providers can take a little more risk because generally the installment loans are secured. So let's look across at the balances. We see some pretty significant balance variations across the country. We're all the way over in the West. We're at 229,000 in terms of average balance. And if we go to the Northeast, we're at 165,000. So a couple of factors in here. You could say that, well, generally it's more expensive to operate a business in the West. You might say that. You could say that confidence of business in the West over the last several years has been better. We don't know if that's the case or not, but they definitely are borrowing more money than the Northeast and several other regions around the country. You will see that the charge-off balances are very low. I would say that is largely related to the fact of the availability of collateral to secure the loans, reducing losses. And then we look all the way down the bottom at the charged-off, or at the percentage balance is 91 days plus. Highest level, Southwest at 1.39, which is higher than the others, but again, not a dramatic or historically high percentage of 91 days past due. Let's look at lines of credit. Think about lines of credit as kind of being between the two, installment and credit cards. A little bit more difficult to access initially than credit cards, and a lot more variable. So the providers have a lot more control over that. you will see that the consumer credits, or excuse me, the commercial credit scores across the board are pretty good. Southwest dips a little bit down to 56, but not a tremendous variation from the rest of the regions. Charged off balances are consistently low. 91 days past due, consistently low. So all of this is supporting the overall narrative of good, solid, sustainable credit performance on average across regions, across states, and across industries. Again, on average. So let's look a little bit more deeply, a little bit more closely at the credit cards, charge-offs, and 91 days past due. So what we're going to do in the following graphics and illustrations is demonstrate two things. One is, again, by and large, performance is really good. But the second is, there are some outliers where there's not a tremendous amount of variation from the norm, but there's enough where they may be worth a closer look. So let's take this as an example. We've got good alignment and clustering at the bottom of the chart. That is the percent of accounts charged off, balances charged off, percent of accounts in units over 91 days. So they're all in pretty good alignment. And then at the top, we see a little bit of a spike, a little bit of an upward trend. And in pure percentages, a reasonably significant variation from the others. That line is the percentage of the balance in the portfolios over 90 days. So overall in credit cards, we're seeing that year over year, those balances, severe delinquent balances in credit cards, increase from 0.75 to 0.95. Not a dramatic cause for concern, but something to be aware of. And it makes sense when you think about what Kyle said earlier about the 7% plus growth year over year on the credit card side. Something to be aware of. Let's look at installment loans. Again, same data where we have percent accounts charged off, percent balance charged off, and then we have the severe delinquencies. So at the bottom of the chart, you've got the charge-offs, very low, generally stable over multiple quarters. Let's look up towards the top of the illustration. In terms of accounts, 91 days plus, a 22 basis point increase. In terms of balances, 91 days plus, a 30% or 30 basis point increase. Worth looking at. The news on this is that there's pretty tight alignment between the number of accounts and the balances past due, which tells us there's not a concentration in this portfolio in general at the higher end of balances. Let's think about lines of credit. All the trends are down or stable. Very positive, matches up with the overall story with the presentation, solid performance, a stable trend or a downward trend overall. So the next thing we thought was, well, let's compare small businesses with medium and large small businesses, for want of a better way of putting it. So on the very small side, we've seen an uptick over the last quarter. The trend was pretty stable. Over the last quarter, it's gone to where it was in Q3 2015. On the larger small business side, we see a downward trend. A little earlier on, the comment was made, I think it was Derek that made it, that small businesses tend to be more at risk or susceptible to changes in their market or changes in the environment. They can't absorb them as well as larger businesses. So this perhaps is what we're seeing in this particular chart. The interesting thing will be to observe what changes in tax and regulatory oversight will do to that over the ensuing quarters. Okay, let's look at variations. So we looked at the balances, we looked at delinquencies on unit level, and then we said, well, let's go and look at industries. See, is there something there that might be of interest? So let's look at the grayed out area towards the bottom. That is an incredible level of alignment and tightness across the majority of industries. The trend is solid. It's flat. It again matches the overall opinion and presentation here. A couple of exceptions, none of which will be a surprise. We saw some upward ticks in mining, transportation, public utilities, and retail. Now let me clarify the difference between this commentary and Derek's. Derek's commentary on these topics was largely related to growth. It was positive, back on track for each of these segments. This is balances and delinquency at the time of measurement. So what we would expect to see is when we get to the next quarter's data, based on what Derek just said, we would expect to see these three industries return to a trend similar to the rest of the industries noted here. Just wanted to point out one of these other trends that I thought was pretty interesting, how solid and stable manufacturing has been in terms of credit card balances, credit card delinquencies. Now, just to put that in context, in manufacturing, in small business, you're talking about a lot of subcontractors. Think about the auto industry, a lot of OEM contractors, manufacturers supplying the auto industry. They tend to have bigger contracts. Sometimes they will use credit cards to get them from completion of projects, completion of shipments, through to the time when they finally get paid. So what this tells us is that they are doing a really good job, A, of controlling their receivables and payables and using their credit cards, but B, it may also be an indicator that the companies that they're supplying are paying on time, all of which is pretty positive. Look at installment loans. There are two trends I wanted to show you here. One is related to mining, and the other is related to wholesale. Delinquency, the percentage of dollars outstanding beyond 91 days past due has dropped off on both of those segments. That, again, connects in well with what Derek said earlier. And towards the bottom of the chart, you can see, again, that generally tight alignment, the general stable or downward trend. Installment loan balances, severe delinquency by industry. The major outlier here was transportation and public utilities. We would expect that to come back in line in the next quarter. Mining. This is an ongoing theme in our discussions over the last several quarters. Significant drop-off. We think that part of that has been the two things: the shakeout in the industry, where essentially if the suppliers and small companies that are part of that industry survived all the issues related to commodities over the last couple of years, then essentially they are pretty strong, pretty robust, well-organized, well-managed. That in combination with the fact that there were some significant charge-offs and bankruptcies that kind of right-sized the space over the last year or so is where that significant drop over the last several quarters came from. Credit cards by regions. General comment here is slight upward trend over the last quarter, maybe 2 quarters. But again, I want to call your attention to the left-hand side of the slide. At the highest point, we're still right at or slightly below 1%. Robust performance, solid management, aligning with the optimism from earlier, aligning with growth, and so on. Took the Northeast as an example, slight uptick, but again, small in terms of the delta, the difference between Q2 and Q3. We then said, all right, well, let's take the Northeast as an example. Where's that coming from? When we see these slight upticks across regions, is there something in the background that's driving that? The 4 industries we've looked at are the ones where they had the most significant contribution to that overall performance level. And again, just to show you at the bottom here, there was a jump in mining. This is severe delinquency, but we again would expect that to fall away over the next several quarters based on growth and the resolution of the questions related to commodity pricing. We looked at this data across all industries, across all the regions, and we see a similar trend. There is probably a 95% alignment in terms of stability or downward trends on the key indicators of credit performance and quality. The outliers, we know where they are, and we would expect those outliers in general to come back into alignment over the next several quarters. Installment loans, slight uptick across regions, but again, highest point is 1.4%. Severe delinquency, good performance. We looked at the Southwest. What looks like a significant jump there is in pure terms relatively small. We said let's look at the information on a segment industry basis below that, and we saw that the two contributors were construction and transport and public utilities. The macroeconomic picture related to growth, wage growth across several segments, the general positive outlook tells us that these industries will come back into line in terms of performance over the next several quarters. Let me just jump ahead here. Lines of credit, balance past due, 91 days plus, severe delinquency. A very good, solid, consistent downward trend across all the regions. Midwest in particular, we took a look at that. You can see where those major drops happened. So performance, credit performance has improved dramatically over the last couple of quarters. Okay, so here's the general picture. It's positive. There's a lot of growth. That growth's projected to continue. All of the credit performance indicators are solid. They are stable or trending downwards with some exceptions. When we look at the exceptions are related to industries like transportation, mining, utilities, and so on, where there may be a lag effect in terms of growth. So performance is good. Situation is very positive. We will be interested to observe over the next several quarters what happens from a taxation regulatory perspective, how that impacts not only the sentiment, but how it impacts these underlying credit metrics. So with that, I will thank you for joining us today. We really appreciate the time, and I will hand back to Gary.